Well, off to the fourth week. So tonight we're going to talk a little about banking, things like that. Some other stuff. Let's see, interest rates. Interest rates right now are obviously it's quite significant. The interest rates we're looking at during the time of inflation, but we'll discuss a little bit more. Talk about different kinds of institutions, banks, and other things. When the book kind of talks about commercial banks and you think about the big banks like the Wall Street banks, those guys don't operate the same way that retail banks. And really, when they say commercial banks, they're generally talking about retail banks. Commercial banks, in my mind, would be the big banks that may have a namesake, down at the lower levels. You might find a J.P. Morgan or something like that, maybe a Chase credit card or some sort of entity, but for branding purposes. But those big Wall Street banks, they don't get involved in this kind of stuff, and they don't necessarily even loan money, back and forth. They don't operate the same way small banks do. They orchestrate things. They organize, mergers and acquisitions and stuff like that. They do big things. So when they say commercial banks, keep in mind that their definition may be a little different than I think what is commercially or what is usually understood. Okay, for you though, banks and financial institutions are the mechanism in which they hold some money, hopefully not much money, because banks and stuff like that, they don't pay much in the way of interest. But they're very fluid. They have liquidity. Liquidity is the ability for you to gain access to cash. The other thing about them is, depositors insured, FDIC, up to $250,000 per depositor. Well, when we see a few banks fail, which they did, the Silicon Valley Bank, and obviously pretty well politically connected bank, they covered these guys up to the limit. The government took it over, and the people who owned shares in the bank, they got clobbered. The investors in the bank, they got hammered pretty bad. But the individual investors, even though most of them were big millionaire, just based on the location and based on the type of clientele they had, they were not, not mom and pop type things. Okay, so saving institutions, thrift institutions. Yeah, sometimes deposits, mortgages, credit unions. So again, the authors are going to try and split hairs here it's like, this was back to the Reagan era, so we're talking basically the 80s where Reagan deregulated a lot of the banks and enabled banks to do a variety of functions. So before that time, you had very distinct institutions. You had, credit unions, but they couldn't get involved and they couldn't necessarily operate like a bank, and banks could only do certain things, and you had savings and loan type things. And anyway, now it's just kind of a blend. You'll find that, here locally, I guess we've got it global now, which, anyway, branding-wise, I'm not sure why Alaska USA seem to be a fine bank, but fine name. But anyway, I guess their operations are bigger, but not sure I would have chosen global as a name, but that's their business. But anyway, then you may have another bank like, say, Wells Fargo or First National or something like that, Northrim, and the functions that these guys provide are quite a bit the same. For you at the personal finance level, do you really care? No. If the credit union's closer or going to give you a better rate, you might as well go there. Or if it's the Wells Fargo and you don't have issues with their customer service or something like that, maybe you'll go there. But people have preferences based upon banks, and a lot of times it doesn't have to do with what their foundation institution in terms of doctrine was. So they make a big deal about it. The only difference with credit union is they call you member. You don't have to be. It used to be in the teachers union, go to the certain credit unions you had to be a teacher, and you go to other ones you had to be, a military person. All that stuff's kind of gone away. Non-depository institutions, finance companies, personal loans to individuals. A lot of times these are maybe not the folks you want to deal with. The term finance company, there's some people that are credible, but then there's others that are kind of lenders of last resort, meaning, oh yeah, they may give you a loan, but the reason you ended up there is because your credit's not good, and the reason they're going to offer you a loan is because their interest rates aren't competitive, but you don't have many options because your credit is not good, you've got some issues or something like that. So I mean, you could call some of these folks predatory lenders, but when you really need a loan, sometimes you want a predator out there because you're that desperate. The same thing happens in the housing market when prices drop and these people swoop in and buy the mortgage. Yeah, are they sort of vultures? Sure, but if they weren't there, the prices would continue to drop. So thank God there's somebody there to put a floor to where prices will only drop so far before people like that will swoop in, and so they perform a function. Not great people, not probably a business you want to be involved in, but are they necessary? Quite. So anyway, securities firms. Now these guys is where I keep most of my money, and where most people with any sort of wealth, not that I'm a wealthy guy, but anyway, I think it's a good idea even for most of you, once you get to a point where you've got excess cash and you're not wanting to keep it in your savings account because that's not smart in terms of the risk that could happen there in terms of identity theft or just the psychological. If you got 20 grand sitting in your checking account, you're going to find something you need, and all it takes is one day of weakness and you're not in as good a financial position. So you ought to have maybe a second account in a brokerage, in a security firm, whatever you want to call it, the same sort of thing, but it has a bit of a boundary. It's generally not local, generally takes you, well, you can write checks on a lot of these. In fact, you can get credit cards associated with these, but for the most part, I don't do that any longer. I have done it in the past, but it's a minimum of 3 days to a week to get at that money, so it provides a little bit of a buffer and also a little bit of a psychological buffer where money that ends up in there should stay there unless there's an emergency. It should be invested. And they, specialize in what they do, and there ought to be a higher interest rate paid to you as a saver to keep the money there. Insurance companies, they can provide some of these things. They can provide insurance, which is good, but sometimes they're also used with some of the life insurance policies. They're actually hybrid life insurance / savings policies, and they don't necessarily work out well for you as the saver. You would be better off having your money generally in a brokerage and a company that's focused solely on making you money, rather than these hybrid products where it's insurance and it's a savings product, and by the way, it's not competitive. They don't pay the same rates. They don't have the same sort of performance that the true investor type institutions do. So again, investment companies. What's the difference between an investment company and a brokerage? I defy them to tell me what the difference is. They mention the word mutual funds in here, which is a form of basically it's a collection of stocks that are put under a single fund, and we'll talk more about that later in the class. But it's a good product because and there's more mutual funds out there than there are individual companies. But what they'll do is, let's say you want to invest in whatever it is. Right now I'm looking at Bitcoin mining companies, which is probably a little risky. But anyway, to make it a little less risky, if I expect, Bitcoin mining companies to do well based upon, certain events, the Bitcoin's quite low right now. The halving's going to happen next spring. If I expect Bitcoin to go up, I might want to get involved in the mining companies because I would expect their stock price to go up as Bitcoin goes up. Now, I could just pick an individual company in there, Riot or Marathon or I guess there's anyway a bunch of different companies involved in Bitcoin mining. So I've defined that I expect the sector to go up. Now, if I pick an individual company within that sector to go up, I'm kind of making myself a little bit more risky because now I not only have to be right about that sector doing well, but I have to be right about that individual company doing well. And, if I'm correct on both counts, I'm going to make a ton of money. If I'm correct on Bitcoin going up, but it doesn't end up being Riot as the company that leads the charge, they have some other problem, then I could be right, but still, potentially lose money. So maybe a safer bet is to say, I think it's a no-brainer, Bitcoin's going up, so I'm going to invest across that sector, and I'm going to find a mutual fund that deals in crypto mining, Bitcoin mining, and therefore I'm going to find a mutual fund. I guarantee I'm just, talking here, and probably at the end of class I'll go through and I'll look on the internet. I could pretty much guarantee I'll find a mutual fund that matches what I'm talking about. So anyway, in this case, they're talking about investment companies selling mutual funds. Well, guess what? Brokerages sell mutual funds. And brokerages also sell a product called an ETF, an exchange-traded fund, which mirrors a lot of the things about stocks. So we'll talk more in details, but a broad overview, that's what mutual funds are. Financial conglomerates. Well, if they would have started there, that's what I keep saying. Pretty much all the big boys. There's been a lot of consolidation, and there's certain companies that have it all, So it could be, I guess Ameritrade's gone, but they got taken over by Schwab that's got all that stuff. Fidelity, Vanguard, there's big companies in there that do all of that stuff. And Bank of America, Citigroup could also do it, but I tend to want, if I am going to have an individual bank, I actually have a couple banks, but one might be a local bank, and if I'm going to go with a local bank, it's probably going to be somebody who's actually based predominantly in Alaska. So if my other money is going to be off in a brokerage firm, a big multinational company, I might be more local for a local bank. Anyway, this is how they work. So financial conglomerates, they're just talking about how they have different divisions, which isn't unusual. Checking accounts. So checking accounts are a necessary thing. Now, are you still writing checks out of them? No, not always. You might be using debit cards, but you need some place for your direct deposit to go. Just about any company now, just for ease of everything, is going to be emphasizing direct deposit. And the IRS definitely wants direct deposit. They want to be able to monitor everything, and whatever. The big banks want to be friendly with the IRS. Everybody wants to. Anyway, so there's not a lot of challenges. If we go, a central currency, then it's going to get even worse. But anyway, you're probably going to end up with a checking account with most of your money passing through it. And again, I would advise you to probably keep enough money in there to meet your monthly liquidity needs, but I would not, that's a no-brainer. This isn't even really advice. Don't keep money in there as like a savings type thing, because the savings rates they pay are nothing. And the handcuffs they put on you, maybe you have to have a minimum balance, which means you're getting no interest on that first chunk of money. But even the interest they're talking about is fractions of a percent. When inflation is, 10 times, 100 times that, you're not making money. So don't fool yourself. Keep a minimum amount of money in there, and put your other money in investments. Fees to be charged, so paying bills after the deadlines, making loan payments after the deadline. Anyway, you know how all this works. Payment penalties. The one thing, though, about if you're bouncing checks, those penalties are typically not waived. But if you're late, say to the phone company or to the credit card company, and they hit you with $15. In fact, I had this happen just a few weeks ago, where I knew the date was coming up, but I also knew that I had a check coming in, and I didn't want to, I keep not that much money in my checking account, and so I wanted that check to be in there. So I paid it on the due date exactly. Well, they went by the due date on the East Coast, and they hit me with a thing. So rather than get real snotty with them, I just called them up and I said, hey, this thing was paid on time, and whether or not, whatever. I didn't even have to argue with them. Since it's only happens once in a while, they're like, oh, okay, and we'll waive it and we'll put it back in your account. So, granted, it's, $15, $30, whatever they were trying to hit me with, but, it's money back in my pocket. So, call those people first as soon as it happens. And, I've never had any luck with email or chat with any of that stuff, but now the phone systems you'll see on customer service are kind of going away too, but good luck with that. All right. Banking services. Debit cards. Debit cards are great. The only problem with debit card, though, is it is kind of hard to keep track of your balance. Typically when you write a check, maybe there's a carbon, maybe you put it in a register, maybe whatever. But I find that it's hard to keep track of my purchases out of a debit card. Obviously, we know all the apps on the smartphones. I've talked about some of the risks involved in that, your personal information. But again, man, the merchants, the government, everybody wants you to go electronic because it makes it easier, makes the transaction charges much less. Keeping cash around, counting out change, things like that, big hassle for those guys. And if they can get you to go cashless, they would love it. And there's plenty of smart reasons not to do that, but you're kind of the salmon going the wrong way in the stream. Online banking also gaining popularity. Yeah, it's online banking dwarfs the other banking now. So all this stuff again. They're kind of living in the 80s. Record checks in your checkbook as you write them. Most people don't write that many checks, to tell you the truth. I had a Danish student one time come up to me after class and was like wanting me to explain to him how to even write a check and why we even. I mean, he just didn't get the whole point of the check because he was in Europe and they're just not used. And a lot of times, credit in Europe was, at least at the time, was definitely frowned upon because if you use a credit card, they would look at you and go, well, "What's wrong? You can't afford this. You can't use cash." And anyway, it was just kind of clumsy. They also have a different system over there. When they do use a credit card, it's more like a debit card, whereas if you use a credit card, you can expect them to come to you, generally with a little handheld thing, for you to enter your PIN on your credit card. So, if you are going to be traveling, keep in mind if there's a PIN number associated with your credit card, you might want to do it because they'll may ask you for it. And typically there is a PIN number. Anyway, reconciling your bank account with your register. Now, again, this gets back to the online banking. If there's any fraud or anything going on, and I doubt that any of you have not had some sort of fraud on your account. I mean, I burn through credit cards about once every, sometimes it's as often as 6 months, 6-month average, where bogus charges show up and, they send me a little note, are these charges yours? And you say no, and then they nuke the credit card, and you got to wait a day or two to get a new one. that's if you insist upon them overnighting the card. And if you do enough transactions, they usually don't have any problem. But if you're on a trip or something and they happen to zap your credit card and you're wholly dependent upon that credit card, that can be a problem. And so it helps to have a second credit card, and not to give you rat out certain companies, but I would not count like an American Express card as a second card, because I've been in many situations where that's not taken. And the problem is as a merchant, when I sell stuff and somebody has a American Express card, it's kind of a drag, because it's bad enough if I take a credit card, I got to pay 3%. American Express is 4.5 or whatever it was. It was, quite a bit higher, and that's coming out of my pocket. If I sell you something for $100, I'm getting $95.50. It's bad enough I'm only getting $97. If I sell it to you on MasterCard, but if I can get you to buy more, I'm all for it. But anyway. So sometimes you need a backup. Check float. This is kind of a thing of the past. Things now are generally processed electronically. There used to be a time where you could write a check and it would be out there floating. And then, I remember, coming out of an aviation background, I had a number of friends who built time flying checks for banks, because they would fly them down to the big central bank, from... If you lived out in the sticks, they would have a private pilot fly the checks overnight so that they got there, their money. Now that things are processed electronically, it doesn't happen as much. But anyway, what you need to do is you need to check your balance quite often, and don't be under the impression that I'm going to write the check now and I'm going to have time for that. Me to deposit some money. If they process it electronically, no, you're not. So debit cards, debit cards are, like I say, cool. The debit cards, I used to have a debit card that paid me 15 cents per transaction, and not that it's a huge amount of money, but you end up with a couple beers worth of money by the end of the month if you used it as much as I did. But safety deposit box. There aren't nearly enough safety deposit boxes to go around, even if everybody wanted one. It's kind of an old school thing. I think most people, have some sort of safe or something like that where they store documents. Some people may still have safety deposit boxes, but I can guarantee you, in Alaska, there's not a safety deposit box for every citizen. That's for sure. I would be shocked if there were more than a few thousand for 700,000 people. ATMs, we all are familiar with ATMs. So this ATMs, though, if you're somebody who uses ATMs a lot and you're getting hit with any fees or charges, you need to find a different bank. I mean, some banks too will have you, there's no charge if it's in our network, if it's used at our bank. And if you have to drive a few miles, especially given the price of gas, to get to the right ATM, I mean, number one, it's a hassle, but that cost it's not necessarily. There are banks out there. I've had a bank for years, and regardless of how much the institution charges, whether it's $3 or $2 or even $4 at the ATMs, it all gets reimbursed to me at the end of the month. So they, for the bank that I use, the main bank is one located out of Texas, but they know that they're not going to put ATMs up here in Alaska or all over the nation. And so by not having to put up with that expense, they just go ahead and pay those fees. So, but it's a convenience that if they didn't offer, I'd find another bank that did. And that's the thing. So the homework assignment tonight is going to be to look at your bank. And maybe you ended up with a bank because that's what you've always had. That's what your parents had. That's what, whatever. Things have changed, especially on the business banking end. Wow, I use a bank, it's a strictly online bank. So much easier and cheaper than any of the local banks. Local banks were charging me to do mobile deposits. There was a fee. to do, monthly, just monthly charges. And granted, I was a small business. If I was a big business, maybe it'd be worth it. But there was, $8 for the monthly fee, $15 to deposit mobile. I'm like, no, especially if it's seasonal. So there's an online bank that I'm super happy with, and it's just strictly a business bank, but there's no service charges on anything because, they know I'll have money there, and they're making money off my money. That's how banks do it. Banks make money by when you deposit money there, your money doesn't sit there in their vault. That's how banks fail. Banks fail when there's a panic and all the depositors come to get their come to get their money on the same day. The banks don't have it. The banks, that's not the way they work. Banks keep only a percentage, and then they go ahead and loan out your money. So they pay you a fraction of a percent, and then they loan it out at 5 or 8% or whatever on car loans and other stuff. And so when banks are whatever, there has to be trust in banks, because if there's a run on the bank, if everybody goes to the bank to get their cash at one time, the whole system completely fails, and fails miserably. That one of the biggest banks around, and again, I'm not a fan of them, but I do have some stuff with them. But Bank of America, how they got to be as big as they were was back in the Great Depression. At the time, they're actually called the Bank of Italy, and they're based in San Francisco. And people were nervous, and they were running on all the banks, and whatever, the Bank of Italy there, they got these big gold reserves and stacks of cash, and they had it all out, basically in the front windows on display. And so when people came to get their money back, they saw that this bank had tons of cash, on display. Obviously, they didn't have as much as the depositors would have taken if they all showed up at once, but it gave people, whatever, is a great psychological move, because it gave people confidence in the bank, and the people then asked to withdraw all their money. They kept it in there, whereas their competitors, people didn't have faith in them, and they raided them, and not raided them, they just demanded all their money back until the banks are insolvent. And they've got what we're talking about in terms of liquidity. They had the assets, but they didn't have the assets on hand. They didn't have the liquidity. So anyway, then World War II came, and obviously Italy was in there, Mussolini and Hitler and all that stuff. So Bank of Italy was no longer such a good name, so why not name yourself Bank of America? So unlike my example with Alaska USA switching to Global, Bank of Italy switched to Bank of America, and a little smarter, a little more brand friendly. Okay, cashier's check. What happens with a cashier's check is normally when you write a check, some people are very hesitant to take a personal check from somebody because there's no verification that money is in the account. Well, with a cashier's check, say you go to the bank, and you can't write a cashier's check yourself. You have to go to the bank and get a cashier's check issued. So you go to the cashier's check and you say, okay, I'm going to buy this thing. I want a cashier's check for 20 grand. The bank will go to that account, and they'll just put a hold on that account for that amount of 20,000, and then they'll go ahead and issue that cashier's check. So if you get a cashier's check, you have confidence that if it's a genuine check, if it's not a forgery or something, there are sufficient funds in that account to make it. So anyway, I've taken cashier's checks on a number of times. In fact, I took a cashier's check. It was about a $20,000 cashier's check, and I took it to one of the local banks because I'd sold a piece of equipment, and they said, well, we've got to put a hold on it for 4 or 5 days, which is a complete scam. And so I said, no. So I went and started another account with a different bank, and I said, okay, I have a cashier's check. Will you cash it today? Well, certainly, because we know the funds are there, and boom. So that's how, sometimes you have problems with a bank and you have to switch banks. Don't be afraid to switch banks because, again, the big ones get a little complacent, the smaller upstarts, whatever. There's different characteristics, but good banks come and go, and they're not always the same. A money order is something that you probably won't encounter very often. Again, which is not a bad thing. Money orders are necessary, and I use money orders literally about once every 10 years because for some reason the State Department, when you have to get a new passport, they require money orders. There might be another occasion, but for the most part they're kind of obsolete. But what they are useful for are people that are what they call unbanked, and people who don't have any checking account, don't have any, usually are not knocking it out of the park financially in terms of life, or just getting by, and they do their banking at, say, the Walmart customer service thing or whatever, and they're having to rely on money orders. It can get them by. But if you did it on a if you had to write a number of them, they're charging you per item, and not only is it kind of a hassle, but it's certainly going to get expensive. So it's one of those things, it's very expensive to be poor. If you're, the free checking, the free this, the free that goes to people with lots of money. The people who are on the bottom rung, I used to work with a lot of folks who were, I don't know what the common vernacular would be, but let's just say undocumented folks in digging ditches when I was in college. And these poor guys, my God, they would have to, they would get a check, but they didn't have an ID to cash the check. And so, the company would write them a check, and the little 7-Eleven or whatever knew the game. And so they would cash the check for them at this convenience store with the understanding, or not the understanding, the obligation that they had to spend over half of their check at that store. So these guys are buying all their groceries at the convenience store at at those sort of prices. And so it was, again, it was predatory. It wasn't good, but what else were these guys going to do? And there were other issues too, because they, I asked one of the guys, these guys were friends of mine. I asked him where he got his Social Security number. He just pointed to his head. He made it up. So he had just grabbed a random group of numbers, which is all, well, it means that the government's going to get a bunch of extra money because they're going to withhold Social Security from this guy's check that he's never, ever going to see. And then the other thing is, if he happens to, if you win this lottery and this guy happens to pick your Social Security number, now all of a sudden you're going to get a W-2. The IRS is getting all this information that you're earned all this money. It's usually pretty easy to decipher because you're probably in different, geographic location. But anyway, just the whole thing just ripples and creates a big mess. But people who don't have checking accounts, money orders is something they might encounter. For you, probably not, which is a good thing. Traveler's check, kind of a joke. I've been in some very far-flung places, in Turkey and Bulgaria and just, well, actually, Bulgaria is pretty nice, pretty advanced, but other places in the Middle East, and I've seen tourists with traveler's checks, and these guys are like, yeah, no, we don't take that. And I don't have the local currency, but I've got a credit card, and they're more than happy to deal with me. So, anyway, I'm not sure if you guys will even see travelers. I haven't seen the traveler's check in a long time, and I wouldn't buy them, use them myself anymore. But check on where you're going if you're doing some traveling, but not very useful. So the criteria, I kind of hit on this before, and this is what you'll talk about during your homework assignment. Now, again, you're not going to find some of this information in the book, and you're not going to find this question highlighted so much in your book. You're going to have to figure it out kind of on your own. It's not that difficult, but you're going to look at some of your banking options, and you're going to, probably make like a little matrix of what's important to you, whether it's ATM fees, location, doing business locally, whatever your criteria is for selecting your bank, and then since you can do this all online, you can look and see how some of the, other things compare to it, and whether it be, local banks or online banks or whatever. I mean, I've got a bank in Texas, like I say, that's far easier to work with than some of the local banks. I can do international wire transfers, which I used to do quite a bit when I had real estate overseas, and I can do it all by phone with the bank in Texas, and in Alaska, oh no, I had to come in. So it's like, wait a minute, the bank in Texas is far easier to get this done because I don't have to, set aside everything and drive to the branch. But if you do have to transfer money like that anymore, there's international companies that charge a fraction of the fee. So things have changed so much in the banking industry. So you have to kind of pay attention to what is the newest and greatest thing, and generally in the online area. Paying bills online, yeah, way easier. Deposit rates and insurance. Yep. Now, I'm not so concerned with the rates on investments with the banks because they're all pitiful. There's not a one that's paying anything that's even close to inflation. So I don't keep enough money in there to make it a significant factor. Any money that's over and above, if you're living within your means and you're ending up with extra money, what you need to do is go through and scrape off that extra money and put it in your brokerage account. And you should have maybe a percentage being transferred to that account each month. So it shouldn't be huge amounts. And again, since this is all orchestrated by you, the percentage to transfer, the automatic payments and all that stuff, if you get in a bind, you can certainly, transfer it back and forth by yourself without any problem. Generally no fees. So fees, some consumers use Walmart to avoid fees. Yeah, that gets bound to the unbanked thing, where you're doing such a small number of transactions. Walmart's not free on most of these things, not to my mind. And especially, if you're doing overseas remittances and stuff. Western Union, they're certainly not free. So interest rates, yep. So they have some types of deposits that they can do within banks and stuff. So they'll give you a little bit higher rate. But what they do on some of these is a certificate of deposit. Well, it usually comes with a time associated with it. We'll give you, say, 3 or 5% if you commit to keeping the money there for 3 to 5 years. And if you pull it out early, there's going to be a penalty that's going to take away all that interest you made. Again, I'm not using a banking institution to park large chunks of money. Risk-free, rate of return. So anyway, there's certain things where when you look at an interest rate, there's a certain amount of interest that's due to, like, the prime rate, that is due to just the cost of money. And say that's 5%. And then there's another rate that's tacked on top of that based upon your credit worthiness. So, if two people walk into the bank and one person, let's say the risk-free rate of return or the risk-free interest they're going to charge is 5%, you might be able to walk in there and get a loan for 6% because you don't have much personal risk. You're not much risk over the cost of money. But if you've got sketchy credit, you go into that bank and now your rate may be 12% or something like that, quite a bit higher, because they not only have to cover the cost of renting that money basically, but they also have to add something in because you have a history of being flaky or maybe not the resources to pay it off if you got in a jam. So that risk premium is, the other part. Loan rate. So this is how banks work. Yep. And exactly what I was saying. Individuals with a poor credit history pay higher fees. Completely fair. That's why it's important to have a good credit score. But, like I say, you know, banks loan people to money who don't need it. Banks don't want to loan people to, who really need it, because that factor is so high that your risk is high. So, anyway, the best person to get a loan from is yourself. If you have a bunch of money in your 401k, you can take a loan right now with virtually no paperwork, no approval, none of that stuff against your 401k money, and you might pay, say 3 to 5% to borrow that money. But guess who gets the interest? You do. It goes back into your account. So essentially, you're taking a loan from yourself. So it's a great deal. But anyway, that's a great source of a loan, rather than going to a bank. Impact of the economy on the risk premium. Yep. Obviously, more willing to invest in a favorable economic climate. Yeah, double up to catch up. A lot of people are really drawn to investing in sketchy stuff. Not me, though. Yeah, with Bitcoin. Anyway, you don't put all of your money, you don't put all of your eggs in one basket, that's for sure. Choice depends on risk tolerance. So if you need the money, yeah, maybe keep it in cash. Or if you go, wow, right now the stock market's probably overblown a little bit for no good reason, I would not be dumping buckets of money in there right now. So that might be a strategy, to keep it in cash, even though inflation's eating it up, but to jump in at the top might be a problem. Anyway, it has to be based upon your risk tolerance as well. So they have T-bills. So again, the amount of interest that's paid to you is going to be proportional to the amount of risk involved. So let's say you're buying T-bills. Well, in order for a T-bill not to pay off, the U.S. government needs to fail. So there's not a whole lot of risk there. A lot of things are going to fail before the federal government. If the federal government fails altogether, we're going to be in a cold, dark place. You better have a backup plan. The least of your problems is probably going to be cash, because cash probably isn't even going to be used at that point. It's backed by the full faith and credit of the U.S. government, which, if they're not paying off the treasury bills, the thing has failed. So anyway, very little risk. So very little return. Shifts in the yield curve. So loan rates. Well, yeah, I deleted a few slides in there just because it got a little bit confusing. But the way banks do this and the way this whole thing works is that banks take in money and they pay you a small amount of interest. They loan out money at a higher interest. That's how all financial dealings work. Monetary policy. This is the Fed trying to control the interest rate. Obviously, we wouldn't have spikes in inflation if they were that good at it. But part of the problem is when they pump so much money in there. We had quantitative easing. We've had, the money machine go burr. We've had, during COVID especially, so much money was introduced into the economy that it caused some inflation, caused some other problems. But anyway, the Fed is the Federal Reserve Board, right? They're a pseudo government agency. They've got some interaction. There's the appointments are approved by the federal government, but they are essentially a private, pseudo private organization, masked in secrecy. The whole, you can go down the rabbit hole in terms of conspiracy theory, but their purported reason is to try to control the interest rates and keep the economy stable. Are they good at it? Mixed results. So they do it by controlling the money supply. So what we had during COVID was we had a great increase in the money supply. and previous to that, we had all the quantitative easing. It was a great time to be in the market a few years back. Tons of money, low interest rates, and that's, whatever. Things are cyclical, and that's where we're at now. People talk about, it's all capitalism. We don't really have capitalism right now. This is crony capitalism at best, because you have so much interaction between the federal government and the private sector. So it's whatever. You get two kinds of people. You get people who want power, and they use that power to get money, and then have people with power, and they use that power to get money. And so what do you end up with at the top? People with power and money, regardless of what their politics are. So why interest rates change? So it comes back to demand for funds. But there's the larger actual economy, the fundamentals of the economy pushing it, and then there's sort of the tinkering at the margins by the federal government. So it can affect the demand. Yep. So very susceptible to needing low interest rates for survival and all that was the high-tech industry, and they're the ones who really gotten beat up in the past few years of the higher inflation. Once the rates went up, they got slaughtered. Okay, so what banking characteristics? So getting back to retail investing and which one. So that's going to be the goal of your homework assignment. So put a little bit of time into it. I know I'll get some emails going, I don't see this problem in the book. I don't understand it. What are we supposed to do? And again, what you're supposed to do is kind of come up with a, maybe convince me a little bit that you've evaluated the different options and this is the best choice. And I'm not trying to get you to switch banks by any means. And I'm not trying to get you to go to some online bank reason. There's plenty of reasons, psychological or other reasons why you want to stay with whatever bank you do, and hey, it's your choice, it's valid. But the reason for your choice should not be ignorance of what's available at the other banks. If you're getting ripped off on ATM fees or ripped off on service fees, well, you should know about it. So don't care how much they offer. Interest rates charged on mortgages. The way mortgages work, just big picture on that. We'll talk about real estate later, but let's say you want to get a home. You can go to Quicken or somebody like that, giddy up, more power to you. But for most of us, you go down to, I don't even know if they still exist. Residential still exists. The home state probably exists. But anyway, you go to maybe a local mortgage broker or lender, and you get pre-approved for a loan, and that way you can go to a real estate salesperson, an agent, and say, I want to look at homes. And they'll say, oh, have you been pre-approved? And say, yep, here I've got my 80% letter. I show that I've got the, and I'm qualified to look at this price of home. So now you're going to go out with a real estate agent who's like, oh, wow, this person's actually serious. If they're a good real estate agent and you're not already pre-qualified, they're not going to be your agent. I mean, I was an agent for a short period of time, and I was pretty small potatoes, but I would not waste my time with somebody who hadn't already got pre-approved for a loan, because they don't know what they got. Anyway, so you get that loan, and you go find your dream home. Great, everything's good. Probably about 2 months later, boom, you get a note. It used to be always from Wells Fargo, but now it's Freedom, seems like. Anyway, one of these big banks, they've basically bought your loan. The local mortgage lender that organized your loan, did all the credit checks, performed a great service for you, they don't have the deep pockets to have all these loans on their books, and so they sell off their loan as you agreed to when you signed up for their service. There was a thing in there saying that, yeah, we're going to sell this loan to Wells Fargo or Freedom or whoever. About 6 weeks later, fairly transparent to you. You just send the checks to a different thing. Interest rates, everything changes the same, and you go on as you did before. And that's how it works. So the notion of going into a bank to get your mortgage is probably pretty remote. For most of us, we're going to go to a specialized mortgage type thing. And again, if they're not competitive, though, if Rocket Mortgage has got the best rate, but probably not. They're probably all going to be competitive, and having somebody local who's got skin in the game, who wants to see this loan complete quickly, is in the same time zone, there's probably going to be advantages to you there, but enough said. Fees for the checking service is very important. Location, yeah, can be important, or if you're strictly online, maybe not even important. ATMs, again, it comes down to fees and convenience. Here we go. Here's the current interest rates. This is what you can get banks today. So some of these are pretty high, but, you know, Synchrony, I had to get a loan for a piece of equipment, and it was part of the conditions of the, it was like in-house credit, but it was done through Synchrony, and I'd heard of them. Barclays, Capital, I guess these guys are banks you've heard of, but anyway, Ally, it used to be GMAC, General Motors Acceptance Corporation. They changed their names. That shows you a little about how great their brand was. They completely abandoned it and came up with a brand new name. This is the inflation rate right now. Now, I'm not sure I kind of believe, especially that it's down. I don't know. If you think prices are stabilized and the rate's only at 3.67, I'm just saying on the stuff I've got to buy, I think we're still up in higher rates. So there can be, depending on how they calculate this, they have a sample market basket of goods, but if you're buying diesel or gasoline or groceries, I think it might be a little bit higher than that. Anyway, so these rates right here, these are not bad, but keep in mind that even wherever we decide inflation is, you're not making much more than inflation, and you're having to, start up some sort of special account with one of these new guys. And oh, by the way, any money you make here is going to be taxable, whereas obviously inflation, you don't see that effect on taxes. So you're not actually going to get to keep whatever percentage you actually see there. Why is that? So this is historically, we used to say inflation was about 3%. So it's only lately that it's kind of sprung up, but it was 8.26. This was in 2022. So we're hitting some highs, and a lot of that had to do with COVID. The amount of money that was printed was crazy. And then quantitative easing with the stock market, where they're pumping money into the market. And it was great time to have money in the market back in here, man, up until about 2020, till COVID hit. And then it peaked a little bit, and then you have it 14% a year increase to the money supply. There's going to be an effect. There's no free lunch. It's going to happen. Now, here's the Dow Jones. This is, starting out very low, and so it's logarithmic and all that. But anyway, if you were invested in the stock market, you can see the Great Depression. You can see the 2007 stuff going on here. But just the same, you can almost put a straight line up there, over the long term. And that's why when you're investing, you tend to invest for the long term. And if you did, you would have gotten about 10% per year. And if you think you're going to time it just perfectly by knowing when the depression is going to stop, you're probably fooling yourself. That's called market timing, and there's people smarter than you and I that have failed miserably at it. Most people get in there, buy, hold, don't panic, write it out, and in this case, it was going to take you a long time to get back up there, but guess what you did? Here, it was just a quick blip, and you're off. Your money's back, and you're going again. If you sell at the bottom, you're kind of, you shouldn't have been there. You have to have a little bit more. You should make investments if you're going to panic and sell at the bottom. So anyway, so that's enough on the banking situation. Managing your money, I've kind of alluded to this, that use the checking account for utility. It's just sort of a tool to manage your small money, get your bills paid, liquidity, but shovel your any excess money and put that in some sort of investment, or even if you're going to keep it in cash, have some sort of barrier across it. So money management made over short term, and then liquidity. Keep coming back to liquidity, just like the test does. So again, when we get close to the midterm, I'll go through what's going to be on the midterm. But yeah, if you don't know liquidity, it's going to beat you up badly, because you'll not miss one question, you'll miss probably 5. It's going to be multiple choice. It's not that hard. So if you know liquidity, you're going to, have 10% of the questions right. But if you don't know liquidity, you're going to keep getting hit. Using credit cards for liquidity, interest rates high. Again, I don't care what the interest rate is, because I'm not going to carry a balance, right? So I'm a convenience user. So, sometimes you might end up in a situation, but that's when you got to have some sort of emergency fund to pay off that balance before the interest rate kicks in. The interest rate's got to exceed that grace period, that billing cycle, which is, typically 30 days. So, so you don't pay those credit cards. Try and return the highest possible return on short-term investments. Certainly, if you've got excess money, like I say, the banks are smart. The IRS is smart. The IRS, like I was talking about last week, if you don't pay your taxes on time, or they felt that you knew you were going to have to pay, $100,000 worth of taxes at the end of the year, and all of a sudden you get this, big bill saying you owe $100,000 on your tax return, guess what? You're going to owe a little something more, because they're going to assess a penalty because they felt that money was theirs and it should have been paid quarterly. I've got to make quarterly payments. It's not nice, but if they think, hey, you owed us money once and we don't want to take a chance that you're going to get a free loan out of us because they see it as their money. Anyway, adequate return, short-term investments. Checking account, very liquid. Overdraft protection, almost essential. So typically, if you have a credit card associated with that account, that's how it works. If you theoretically were to bounce a check or write insufficient funds, rather than any of that process happen, it just rolls on your credit card. So, not a great thing, but certainly not a financially damaging thing. And it's not going to go on your credit record or something like that. It's just going to be like, kind of an oopsie, and you move on. If you don't have it, then, everybody can start assessing fees, and you've got no say in it because you screwed up, and, theoretically technically you did break the law. And so if they want to say $50 is the overdraft fee, then suck it up. You don't get a vote. So not nice. Next thing, stop payment. Stop payment is only useful now because there's not too much of a bank float. Like I said, checks are processed electronically, but if there's ever a lost check, this is useful. If somebody gave you a check and you happen to lose, and they come back to you and say, can you write me another check? I lost the first one. Say, fine, but I'll put a stop payment on the other check. And, oh, by the way, you're going to give me $5 or $10 or whatever the bank charges to put a stop payment on it. So you go to the bank and you say, okay, this, check number so-and-so, I want to put a stop payment on it. So when that check presents, it will not be cashed. Now, if you write a check to somebody for a legitimate expense and you go in there and put a stop payment on it, essentially you bounce the check. When that vendor or whoever you wrote that check to comes to the bank trying to cash it, you better have a pretty good reason why you put that stop payment on it, or else you've, essentially committed another crime. Direct deposits, know that. Fees, very surly. No interest on most checking accounts, or very little interest. Now, okay, so now they're going to start talking about some of these gimmicky kind of names for, checking accounts and stuff, where they're trying to pay some interest, but you and I should probably not be interested because there's not that much interest involved. And your money would be better served going someplace else. Savings deposits, slightly less. So people used to, they always, when you open up a checking account, you want a savings account as well. It's not the same as what I'm talking about, having a separate institution that probably pays a much higher rate. But, probably doesn't even have a presence in Alaska. Probably, located back in Boston or New York or wherever. Omaha, perhaps. That's where TD Ameritrade was. But now, I don't know where Schwab's based, but a lot of these guys seem to be based out of Boston. Anyway, savings deposits pay slightly higher interest. Yeah, I just can't be bothered. It's just another account that doesn't have much utility for me. Maybe you've got a different habit pattern, but for me, I'd have a checking account, and that's kind of it. Certificates of deposits. I mentioned this earlier, but this involves a time element. They'll pay you a higher interest rate, but you got to commit to keeping your money there for a longer time. And they usually have, a $1,000, $5,000 at different CDs. Sometimes they'll call them jumbo CDs, and you got to put a tremendous amount of money in there. Anyway, it's a way to get a higher interest rate, but it's not that high. Money market. So when you have a brokerage account, you'll generally have some sort of asset management account, brokerage account, whatever, with a brokerage institution. And rather than have it one of these accounts located at the bank, most people would have this at a different institution, at a brokerage. So you don't necessarily have to be trading stocks to have, you could keep your money in cash at a brokerage type place, but you'd be kind of silly to. Most people find themselves invested in mutual funds or whatever. But anyway, say you had, an account with those people, and say you had stock or something in different accounts, and you see the need to sell that stock. Well, you don't sell stock and immediately buy another stock with it. There's a transitional period. There's a wait period in there, and you probably don't have your, you may not have your eye on something else you want to buy right then. So it kind of goes to a parking place, an account that's just sort of an account that earns some interest, but it's just a cash account. And so that's typically what a money market account is. Treasury securities. Yep, you can do that. You can do, T-bills, T-bonds. You can get, savings bonds. You can get all that kind of stuff. But there's very little risk involved, and they're not going to probably keep up with inflation for you. So short-term maturities. They can get a little bit more riskier, but again, we're talking negligible risk. Commercial paper means, money lent to generally corporations and stuff. You can also have things that are loaned to municipalities, like municipal bonds and stuff like that. Short-term bond funds, different funds that are out there. Money market yields. So we'll go through this. The book slides are kind of dated, where they have this tabular data. Most anything now is interactive charting. Much more useful, and not so much not a snapshot. They're more fluid and they're interactive. Asset management account, not a whole lot different than a money market account. Again, it has more to do with branding. So they're going to try and pretend that there's a whole lot of differences, but there might be differences in the underlying securities. Obviously, a T-bill is going to be government securities. Now, the fact that you're having to buy a higher amount means you might be able to get a higher interest rate, but anyway. So if you're willing to give up some liquidity, you can probably get a higher return, right? A 1-year CD, you can't touch the money for a year. Well, by definition, your liquidity is going to go down. We talked about credit risk, interest rate, liquidity risk. So credit risk, yeah, that's maybe, the person flaking out. If it's a loan, it's you flaking out. If it's credit risk, it's the whatever. Whoever's borrowing the money may not pay it back. Interest rate risk, that has to do with that the rates may change in the period. If they give you a 1-year CD and they give you 5% interest on it, and all of a sudden interest rates start dropping, they're not going to be happy because now they're paying an interest rate higher than market. They incurred some risk there, and then liquidity, potential loss that could occur as a result of converting into cash. So you pulled it out early or something like that. CNN.com, not so much. No. There's plenty of good sites out there, and just actually Yahoo Finance is not bad. Google Finance. We'll do some research here in a second, but I'll show you the power of some of these interactive charts. Risk of money market. Yeah, lots of things can happen. You can lose your job, get cut back on hours, poor returns. Right. But anyway, having a sound financial plan and really living within your means and allocating just percentages to different things. I keep talking about crypto, but if you're, you would not want to go, perhaps higher than 10% of your investments into crypto. You might think whatever stock is the best, but you A, may not want to buy an individual stock, or B, you may not want to even go into that sector, that whole industry, in a high percentage in case there's a rollback in that particular field. So strong opportunity, weak opportunity. Yep, always have to consider risk return. So what you want to, to get a higher return, you have to take more risk. Now it is possible through, pure foolishness and buffoonery to expose yourself to high risk with a potential of only a low return. That's where you don't want to be. It's not a bad thing to take some risk if there's a potential for a high return, a reasonable potential. But it is a bad thing to take a high risk when, things are stacked against you. So, yep. But there is a risk in doing nothing. Keeping cash on hand, inflation is going to erode the buying power of that money. They're making assessments, whatever. You have to, this type of investment or advice needs to be current. These situations change as cycles change. So the slides are only good at certain snapshots. What you want to do is you want to have enough liquid cash to cover your bills. You want to have your other money in investments, but you want some liquidity in those investments. So, maybe your strategy is to roll, an emergency onto a credit card. And as long as you can get that money, to pay off that credit card within 30 days, you're good. Well, that might be the liquidity you need. So you don't need your investments to be as liquid as a checking account, but you do need them liquid enough to generate cash within 30 days. So that would maybe be your strategy. Different companies out there. Fidelity is a good one. Vanguard. Lots of big boys out there. You may have an association with it. You may have an employer that offers certain companies, and there's nothing worse than having January and February come around. You're getting all these different statements from multiple investment companies that are largely doing the same thing. You may want to consolidate them. And then the term project. I'll talk more about the term project. Tonight's going a little long, and I wanted to explain sort of the mutual fund system to you. Homework. We're going to look at 3 real-world banking options. You're going to make this comparison. Should be able to do it all online. Yeah, look at fees and all that stuff. ATMs, overdraft procedures, and then just write it up. So it's not going to be that difficult. It's tailored to your needs. Okay, so literally it's this easy. We're just going to go on here at Google, and we're going to go Bitcoin Miners are what they call the people who generate Bitcoin. If you're not familiar with Bitcoin, it's a complex mathematical situation where you can generate. That's how Bitcoin is generated, by completing these equations that get harder and harder and more time consuming. And anyway, miners basically are people who have extreme computing assets and usually access to very cheap energy, because that's what the computers are using. And anyway, so those are going to be things. So I'm telling you, there's probably a mutual fund out here that has Bitcoin miners. Valkyrie funds. So here we go. An ETF. So I mentioned exchange traded funds. So that's something. These are kind of nice. They can be traded like a mutual fund, but they can also, they're like a mutual fund, but they can be traded on an exchange, which is kind of nice. And so it's mainly all in ETFs, are their mutual funds. Do we want to go there? Which one are they saying the best? So they do like the Van Eck, the Valkyrie. Okay, so we've seen Valkyrie, and we've got a thing right here. So let's look at Valkyrie. I know nothing about this company, but here are the miners. This is their holdings. So let's say you go, okay, I know Bitcoin miners, they're gonna do well. I want to pick a company. You know, I really, the company I like is Riot, but anyway, that's not one of their companies for whatever reason. I've heard of Bitfarm before, certainly. So anyway, for some reason I think, well, this Bitfarm company, they're going to be the ones that are, they're going to make the most amount of money. I can invest in that Bitfarm. I mean, here's their ticker symbol. I could go in there and I could buy stock in BITF and buy shares of this company individually. Or maybe the smarter, more conservative move might be to buy this Valkyrie mutual fund. I'm using mutual fund and ETF, exchange traded fund, almost synonymously, because they're very close and very identical principle the way they work. And so by buying this Valkyrie fund that has portions of all these different companies, I have diversified. Now I don't care whether, AMD, they're the guys who actually make the chips. Obviously, they're going to, since these miners need computers, they're going to be buying all sorts of, chips. These guys are probably Argo's actually doing farming, actually doing the mining. These guys are doing mining, more mining. But anyway, so they're getting in on the hardware aspect of it. They're getting in on the guys who are actually doing the work. And so I buy into that, and theoretically I'm going to do quite well. Let's see. Since we're on this thing, I also want to show you a little about charting, because we're going to come across this in the slides. You're going to see these guys offer up this basically tabular data, which just means an array of numbers back and forth. So we're going to go over to one of these folks here, Google Finance, right? Google Finance will work. I've got a couple different things I'm looking at here. Don't think that they're great, but anyway, I put in the ticker symbol BITF, right? Comes up to Bitfarms. So that's what a ticker symbol means. Those 4 letters, that's shorthand for that company. Okay? I want to know how they're doing. Boom. They're traded on the NASDAQ. Now, this is so much more powerful than tab data. So this is just one day. Kind of insignificant. We're not day trading. We're not looking at 5 days, a month, 6 months, year to date, 1 year, 5 years. How long has this company actually been around? I don't know. Okay, so they've been around since, over 5 years. But you can see that, just like Bitcoin being super volatile, so are they. And their highest was up at $8.18, and now they're almost down to a penny stock. So is there lots of potential for these guys to go up? Yeah, maybe so. There's also potential for them to go down further. So you don't just, make one snapshot, but at least with this information, I've got more information. I've got, different people giving me different news things that had happened. Oh, why did it make that blip right then? Oh, okay, I get it. Okay, back here in 2021, they announced that they were going to do some expansion. Well, people didn't like that. They went down 15% in a day. Okay, or let's say you're a complete idiot. You bought back here at the total peak, and then you are over here now. You can look at what's interactively happening here. You can see the numbers scrolling across that I'm down 85.7% from where I bought, and I've lost $7 per share, and the volume change. I mean, there's just so much information that can be gleaned from these things. You can get into the financials and all that other stuff. Now, you can tell who the competitors are. Other people in the space, in the realm. Lululemon. I've had Lululemon forever. Great company, great marketing, and I bought them way back when. Now, they did a stock split at a certain point, but I mean, yeah, I've had them from about here up to about here. I mean, it was a very good asset to hold. So, how much was I up? A couple 100%. If I would have held on to it, would have been up nearly 300%. So, anyway, the data that's available to you now through interactive charting, and I haven't paid a dime for this. It's much more powerful. So we'll talk more about this as we get into investments. But yeah, you should just laugh at when they talk about looking up ticker symbols and things like that in a newspaper. Newspapers barely even cover that stuff anymore because it's just not nearly as powerful or interactive as this. So, getting back to the present, though, what you're doing this week is you're talking about your banking situation and doing that homework. I don't think you're going to have any problems. It should be kind of fun. Again, I'm not trying to get you to switch banks, but you may find that, hey, maybe I do need to, and take it from there. Talk to you next week.